This is level 2 of the CFA program, the topic on equity valuation and the reading on discounted dividend valuation. As I'm guessing you've noticed, this is a super long reading. So we have a super long slide deck, but let me go ahead and begin this slide deck by reminding you of some really critical things that we learned from Modigliani and Miller back in 1958 that has great relevance to this particular reading. We know that businesses regularly issue bonds, and the executives of those companies make an explicit promise to its bondholders. They say something like, I promise to pay you interest, and I promise to pay you principal at the maturity date. This is an explicit promise. It's a legal and binding contract. And if the executives fail to deliver on that promise, then the bondholders have some system of recourse. But look at this topic, equity valuation. So when these businesses issue shares of stock, the executives do not make an explicit promise to its shareholders. In fact, I like to think of it as a vague promise. And the vague promise sounds something like this. I might pay you a dividend, and you might be able to go to the floor of the New York Stock Exchange and buy low and sell high. And that probably depends on what I do with all the capital that I raise. If I invest in positive net present value projects, which I hope to do, then I'll be able to pay you a dividend and you'll be able to generate a capital gain. But it's not a legal and binding contract. In fact, I don't have to pay you dividends at all, and there's essentially nothing that you can do about it other than go to the floor of the New York Stock Exchange and sell. So that's really important as we go through all of this. I want you to think about this vague promise. I might pay you dividends, but I might not. And you might be able to generate a capital gain, but you might not. Remember, it all depends on the quality of the product lines that the firm generates. Can those product lines produce enough cash flows to warrant a dividend payment? As you can imagine, we couldn't fit all of the learning outcome statements on one slide. Notice there's one common action word here, calculate. So we're going to get out our financial calculator and do lots and lots of calculations. But I really like that first one there. Compare dividends, free cash flow, residual income as inputs and as models. So we're going to have to worry about those things, and then we're going to have to do lots of calculations. And then moving on to the next slide with the second part of the LOSs, there are a few calculations in there, but we're going to focus here in this area on growth. How about a brief recap of what we learned back in level 1? If we want to compute the value of any kind of a financial security, we could even call it intrinsic value. All we're going to do is take the present value of those expected future cash flows. Let me go back to that bond example, right? What's the price of a bond? Well, it's the present value of the promised interest payments and the present value of the promised principal payments. Well, we're going to just continue along that line of thinking here in this dividend discount model, and we're just going to substitute dividends in there. But for now, just remember, this is a general formula here. Those cash flows, they could be interest, they could be dividends, they could be almost anything. All right, what do shareholders get out of their ownership in a publicly or even a privately held firm? All right, so we get dividends, right? Cash paid to shareholders. And so if we have cash paid to shareholders, then we're probably going to use the dividend discount model, right? Free cash flow, and let me just remind you, let me give you a general definition of free cash flow. It's the amount of cash remaining after all expenses have been paid, including depreciation, including taxes, but not interest, okay? Not interest expense. It's the amount of cash remaining after all expenses have been paid and all investments have been made. So I always tell my students to think of free cash flow as a little store on the corner, and you have a cash register, and it's an entire cash business. Well, free cash flow is the amount of cash in the cash register after all expenses have been paid and after you've reinvested in everything that you need to reinvest in. So of course, if you have free cash flow, you're going to use a free cash flow model. And then residual income is this idea of economic profit, which of course is why the CFA Institute asks us to go back and learn. We have a micro reading and we have a macro reading so we can understand this residual income model. So look over on the right-hand side, steps of applying the discounted cash flow analysis to equity valuation. Select a specific definition of cash flow. Forecast those cash flows. Oh my gosh, that sounds like an easy thing. Oh, let's just forecast. But not only do we have to forecast either dividends or free cash flow or residual income 1 year from now, we've got to do it 2 years from now and 3 years from now and so on and so forth. So the forecast the cash flow sounds like it might be a relatively simple project, but it's probably way more complex than just that. And then, of course, we need to choose a discount rate methodology. Are we going to just pick an interest rate like the rate of inflation? Probably not. Are we going to use the capital asset pricing model? Oh my goodness gracious, that sounds like a great way to choose a discount rate methodology. And then, of course, we'll estimate the discount rate and then go ahead and compute present value. All right, let's go ahead and start with the dividend discount model and look at that LOS. So we want to compare dividends, free cash flow, and residual income as inputs. So we did a little bit of that right here on this slide, although this was a little bit of a review from level 1. And so let's go ahead and decide that we're going to define the cash flows as the dividends. Now, great exam questions are, when is this dividend discount model relevant? Of course, it has to be a dividend paying firm. And of course, there has to be a fairly stable and consistent relationship between the company's dividend policy and its profitability. Dare I say, a high correlation between those two, because if dividends and earnings go like this, right, well, that makes perfect sense then to use this model. But if they go like this, then it probably doesn't. And this, of course, is when an investor is taking a non-control perspective, probably just like you and me, maybe wanting to buy shares of Johnson & Johnson. But that last arrow point down there is probably an important part of the question stem. So make sure as you're reading this question stem on the exam, you look for the words either non-control or control. So non-control perspective, dividend discount model. Now, a few moments ago, I talked about free cash flow, and I gave you kind of a generic and a general definition of free cash flow, but we need to slice it into two components. How about in the purple there, free cash flow to the firm? And this is, going back to Modigliani and Miller, kind of debt plus equity on the right-hand side of the balance sheet. Really, what are we doing with the assets on the left-hand side? So look at that free cash flow to the firm. It's cash flow from operations minus net capital expenditures. So that sounds an awful lot like that general definition that I gave you just a moment ago. But how about if we now slice it even further and say something like, well, what happens if we're just a shareholder and we're interested in probably taking ownership, or at least a minority ownership, in this firm? So notice that definition and the formula for free cash flow to equity. We've got cash flow from operations minus net capital expenditures, which is what we just had. But now we're going to subtract out those payments to the bondholders. So look at that second arrow point. This represents returns just to the equity ownership. And so this is important for a control perspective. Skip down a couple of lines and you'll see that in bold. All right, so when do we use this model? When, of course, we have no history of paying dividends. But sometimes we can use this when firms pay a dividend, but they're way far away from whatever those free cash flows to equity might be. So dividends might be way up here, free cash flow to equity might be way down here, although it's probably likely that the reverse is true. But let's go ahead and talk about correlation in the bottom sentence there. Companies' free cash flows are related to its profitability. That's important. There's got to be some correlation. If we're going to do a substitution, there's got to be a correlation between cash flows and profitability. Now, how about this third model, residual income? This is calculated as the earnings for a particular period above what the investor's required rate of return is, and that required return occurs at the beginning of the period. All right, so I want you to think about this. The shareholders provide the capital at the beginning of a period. It could be $400 million, it could be $4 billion. And when the shareholders turn that money over to the executives, right, and the executives make a vague promise. The shareholders are wagging their fingers at the executives. They're saying something like, look, you can have our money, but you better invest in a positive net present value, and you better generate this required return. So think of that required return as the waggling of the fingers by the shareholders to the executives. So what we're going to do here is we're just going to take the book value per share and then the present value of those expected future residual earnings, and we're going to put those two together and sum those. So this is relevant when there's no dividends. And what I didn't say earlier is because, and let me go back here and do this. Think about this. Suppose cash flow from operations is 10 and net capital expenditures is 8 or 12. Or 6 or 14. You see where I'm going with this? Free cash flow, let me actually go back one more. Free cash flow to the firm can be negative. Of course, free cash flow to equity can be negative as well. So there's no way you can put a negative value for free cash flow, whether it's to equity or to the firm. You can't put that into the numerator, because then, of course, you'll get a negative value, and that doesn't make any sense. So you substitute this residual income model when those free cash flows are expected to be negative. Let me say one more thing here. I get this from Modigliani and Miller, which is where I get lots and lots of stuff that is floating around in my brain. That, look, what's the goal of the business? Maximize shareholder wealth. So we want lots and lots of operating cash flows, right? That's a measure of the quality of those product lines. But we want to reinvest back in them. So we can take those operating cash flows and we can reinvest more than what those cash flows are, which would turn free cash flow into a negative number. So it's never good to have operating cash flows that are negative, but it's okay to have free cash flows that are negative over a relatively short time period. And then, of course, look at that bottom arrow point. The firm's accounting disclosures are of high quality. Didn't we spend a whole reading or two about the quality of earnings? So remember, of all that stuff that we learned, we're relying on high quality, which means things like sustainability and accuracy and persistence, all those things that we talked about. And so we need to make certain somehow that the financial statements, we can believe them. All right, let's go ahead and do some math. There we go. Calculate and interpret. So single period dividend discount model. This is the simplest of all models in the entire world. So if the holding period is just 1 year, then we're going to receive a dividend at the end of year 1, and then we're going to sell the share of stock at the end of year 1. So notice we put in bold red in the numerators, so that D1 is the expected dividends a year from now. And then as soon as we receive that dividend at the end of year 1, we're going to go to the New York Stock Exchange and sell for P1. So notice down in the notation, it's the P1 is the expected price per share at time period 1. So we just sum those two because we receive those on the same day, D1 plus P1, and then we discount them at the required return on equity raised to the 1 power. And so that's the super simplest model that you could probably ever come up with. Present value of the vague promise. What did I say to you just at the beginning of this slide deck? The stock price is going to be the present value of the vague promise. What's the vague promise? I might pay you a dividend. Here, we're calling it D1. You might be able to go to the floor of the New York Stock Exchange and buy low and sell high. We're calling that P1 there. So we're just taking the present value. And of course, you can do this over multiple periods. It doesn't have to be, here, let me go back quickly. It doesn't have to be just a 1-year period. It could be a 2-year or a 5-year or a 10,000 year period. If the Institute gives you a 10,000 year period, just pretend it's the infinite perpetuity that you can compute the present value on. And so there's a good old formula. So there's the DT in bolded red, and then the PN, which that PN is going to be the price expected at the end of the holding period. So here's a 2-year example. So this is super simple. So we're going to get $2 and $2.50 at the end of the next 2 years. We expect to sell that price for $48. So look at the bottom one there, the bottom equation. So we're going to discount the $2 at the 15%, and then we're going to discount the $2.50 and then the 48. And remember, there's a plus sign in between those two numbers because as soon as we receive that $2.50 dividend from ABC Incorporated in this example, then we're going to run to the New York Stock Exchange and sell for $48. So there's our price, $39.92. How do we interpret it? It's the present value of the vague promise, the 2 dividends, and the future selling price. Dealing with future dividends. So what do we know? If you go to Yahoo Finance and just type in a ticker symbol for any of the big companies, you can go and get a history of their dividends for the last 10,000 years, right? And so if you look at it, what you generally see is that, if it were $1 20 years ago, then it went up to $1.01, and then $1.015, and then maybe $1.02, and then maybe $1.03, and then maybe $1.05, and then maybe $5.1. So you have relatively stable growth, but it's not perfectly constant. Now, sometimes there's a jump in those dividends. So after a couple of years, maybe it's $1.16, and then maybe it goes to $1.41, and then $1.42 and $1.43, and then maybe another jump. So that's what we're assuming here, this stylized growth patterns. We're going to say, all right, let's take the simplest of all example. Let's suppose it's a constant growth rate, like 5% forever and ever and ever. And of course, this was developed by the great Myron Gordon in the 1950s. I always call it the Myron Gordon growth model in my class, and I try to convince my students that Myron Gordon is their favorite finance professor, at least in the old days. Then we can do 2 distinct stages of growth, a 2-stage growth model, and then the H model, and then 3 stages of growth. Now, of course, you could have 4 stages of growth and 5 stages and 100 stages of growth if you wanted to, but the chapter ends at 3 distinct stages of growth. So what we have to do is we need to forecast dividends for this fixed period. Maybe there's high growth for 5 years, and then there's normal growth for after that. If it's a 3-stage model, then maybe the growth rate will be 20% for 2 years, and then 10% for 3 years, and then 2% afterwards. So we're going to have to forecast those dividends and then take their present value, right? We have that interpret action word up in the LOS. So interpreting, it's always going to be the present value of the dividends and the present value of that future selling price. Whether or not those dividends, have different growth rates is going to determine which of these models that we use. All right, let's go ahead and start with the first simple one. Gordon growth model. Intrinsic value of the stock determined using the Gordon growth model. All right, so there's the formula on the right. So forget the stuff on the left. So value time period 0 is equal to D1, and that's super important. The dividend in time period 1, we have it bolded in green, divided by the difference between the required return on equity and the growth rate in dividends. Now, we put that in green over there on the right because a classic professor way to try to fool students is to give them the current dividend instead of the dividend at time period 1. So if you're given the current dividend, D0 in red, you need to compound it out at 1 plus the growth rate. And at the risk of offending everyone, I know this sounds like a simple solution here, but I have graduate students who miss this on MBA exams. So please do not make that mistake on the exam. When you are computing the price using the Gordon growth model, make sure you know what is given to you in the question stem. If it says something like the current dividend or today's dividend, that's D0. If they say something like, the dividend 1 year from today, or the expected year one dividend, then that's D1 over in green. Some assumptions here. Of course, we're expecting that dividends will grow indefinitely at a constant rate. So of course you should be thinking, well, Jim, that doesn't sound too terribly realistic. Of course, based on what you just told us about going to Yahoo Finance. And while that may be true, what you can do is you can take historical growth rates for a mature company. And 1 year it might be 1% and 4% and 2% and 3% and maybe even a -3%. And you can do that over 20 years. And you can take the average of those and use the average growth rate in this model, and you still get about the same price that you do for if you actually computed the present value with all of those different prices. So it sounds an awful lot like this is a highly restrictive assumption, and I would never argue with you if you said it was, but it's not as restrictive as you might think. All right, the second point there, of course, we have to assume, here, let me go back here. Look on that far right denominator. We're assuming that R is greater than G. If R is less than G, then we have big problems mathematically. All right, so we're going to assume the growth rate is less than the required return. All right, so Gordon growth model is appropriate for what situations here? Boy, look at that left. Is that red, maroon, that bolded block? That's a good box over there, right? That's what I was telling you earlier, mature firms. So look for that word. Look for that word when the Institute asked you to identify which model is most appropriate. Mature firms think Gordon growth model. But you're also going to use it, and you'll see this here in just a few moments, we're going to use it to compute something that we call terminal value in the two-stage model and in the three-stage model. You can also use it to value broad-based equity indexes, because these equity index will have dividend yields, so it's appropriate there. And you can also use it to help understand and even determine PE ratios and what PE ratios mean in terms of value. You'll see that here in just a few minutes as well. And then we're also going to use this model. We can rearrange it to solve for G. We can rearrange it to solve for R, which is the required return. And then we can use it to help us understand the present value of growth opportunities. So let's take a quick example here. We're given a question stem and a box full of inputs. And the question is just, what is the intrinsic value of the stock? So let's go ahead and pick and choose. So just go ahead and look down at the bottom equation. So the value is equal to $3. So look, this is what I was telling you before. $3 is D0, so we need to compound it out to get D1. We simply multiply it by 1.06. So that numerator is now D1. So that's important for you to know. Now look, you know the Institute, if this is in a multiple choice format, you know the Institute. Choice A is going to be the answer with just 3 in the numerator. You know that. And then what are we going to divide by? R minus G. Well, we know that G is 6%. So look in the bottom right in the denominator, there's 6%. So what are we going to use as the discount rate? And of course, we look up above. We're given a risk-free rate. We're given an equity risk premium. We're giving a beta of 1.4. Let me just remind you, the average beta in the market is 1. The S&P 500 has a beta of 1. So this particular stock has a beta of 1.4, which means it has 40% more systematic risk than the average stock out there. Therefore, it ought to require around 40%. Don't ever let another finance professor hear you say that. It ought to require around 40% more of a return. But of course, we're not going to just round and say 40%. We're going to use the capital asset pricing model. So look, 6 plus 8% is the premium, the risk premium, and multiply that by the beta, so we get 17.2%. as our measure of the required return on equity. And this should make perfect sense because as shareholders, we own well-diversified portfolios. This stock is just one of maybe 50 or 75 stocks. So the relevant measure of risk is the beta of this particular stock, which then points us in the direction to use 17.2 as our discount rate. Oh my gosh, calculate and interpret there. Boy, there was a lot of great interpretation involved in what I just said over the last 2 minutes. And so if you do all the math, you get, what is that, around $28. Now the next question, the next part of this LOS says, all right, well, how do we get that growth rate? Back here, what did we say? There it was 6%, in all these models back here, we just had a lowercase g. Well, how do we come up with it? Well, we need a market price, we need an expected dividend, and we need a required rate of return to compute the implied dividend rate. Now, later on, we're going to calculate some other kind of an estimate for a sustainable growth rate. But all we're going to do in this case is to use the Gordon growth model. There it is at the top. And we're going to rearrange it to solve for G. And so there's some good quick algebra, and you do all the algebra there using those inputs, and you get a growth rate of around 4%. Now, of course, we need to go back to Modigliani and Miller to remind ourselves that if a firm makes $10, right, in earnings, and it pays out $2 in dividends, that means that it has $8 to reinvest. Okay, this is what these growth opportunities, this term is referring to. We're going to take that $8, reinvest it back into the company by doing things like investing in new product lines or making our existing product lines better. So what does this first line tell us? If a firm can earn returns above the required rate of return, then those are growth opportunities. Of course, this is kind of like a marginal cost, marginal benefit analysis. If our shareholders are requiring 8% and we can earn 15% over here by reinvesting back in our product line, well, then we probably should do that. But if we can only earn 2% by buying a treasury bill, then our shareholders probably want this in dividend. So look at the 2 points that we have there. If there are no new projects to invest in with returns that exceed that 8%, then if there are new projects to invest in with returns that exceed 8%, then of course we should do this, right? And notice that we have in bolded over there positive NPV projects. But if those returns are less, then the firm should pay out those dividends, pay out those earnings as dividends. Notice these are called no growth company, and it was Modigliani and Miller in 1958 who introduced us to the concept of a no growth company. All right, let's talk about a little bit more detail about these present value of growth opportunities. All right, so the stock value is going to be, now clearly I'm still going back to the value, the price of a share of stock is the present value of that vague promise. All right, so now look at how it's identified here. We have two components, the value of no growth. So all we're going to do is take the earnings next year divided by that required return. So this is if we have earnings that are constant forever and ever. But then we're going to add the present value of those growth opportunities. So look in the middle in that blue equation there. So the value of the firm today, the stock price today, is equal to the present value of the dividends, right? E1 divided by R, plus the present value of those growth opportunities. Now look at the second and third circle points there. This is one of those, hello McFly. This is an obvious notion, but we thought it was super important to emphasize this because we think this is where the questions are going to arise. At least if I were making up questions, then I would do this. Growth companies have the most value in the PVGO. Companies in slow growth industries have low. So that should make perfect sense. So let's take a look at a quick example here. Let's suppose we have shares selling for $60, future earnings $2, required return is 10%. So we're going to use that formula that we had on the previous page, and then just rearrange it to get the present value of the growth opportunities, and we get 40%. And look at the last sentence there. This is 2/3 of that price. 40 out of 60 is based on future growth opportunities. And so this is what Modigliani and Miller were telling us about relaxing their no growth firm assumption and saying, okay, suppose we have positive NPV projects out there. We can divide the stock price into its two components. The component of just regular old constant, mature growth, mature stable earnings, plus those reinvested cash flows that are going to pay off. And so think about it this way. What's the goal of the business? Maximize shareholder wealth. So what do firms do? They try to develop product lines that become brand names. And brand name product lines generally are mature firms and mature product lines, so their growth rates are not too terribly high. They were at one point, but now they're mature. So what do the executives do with those cash flows from those mature product lines? Well, they reinvest them in more risky cash flows. Just look at the great example. I used this before. I'm going to use it again. Milton Hershey, every day Milton Hershey wakes up and he makes chocolate bars, right? And he's been making chocolate bars for 1,000 years. And then one day, back in the 1990s, he woke up and said, you know what, I'd like to have fresh breath. He said, let's make an icebreaker. And of course, this is tremendous risk for Hershey Foods to undertake. So that was present value of those growth opportunities. Now, of course, 20 or so years later, Icebreakers is its own brand name. And so Milton Hershey gets up and figures out what to do. When you're fooling around online one day, just go to the Hershey Foods webpage and look at all of the product lines that they have that you've never heard of. That's what, here, let me go back here. That's what those present value of those growth opportunities is mostly. I mean, there's some other things in there. But I give you that example to help you help you interpret as part of the action word in that LOS. All right, remember earlier we said something like, hey, Gordon growth model has a lot of good applications. One of them is to give us a better understanding of PE ratios. So this is where we are now. So calculate, interpret, justified, leading and trailing PEs using the Gordon growth model. All right. So look down at that equation at the bottom, and if you kind of blot out the E1, you'll see that's the Gordon growth model. So all we do is divide both sides by E1. So you take the price today over E1, which is the expected earnings per share. So we call this the leading PE ratio. So you divide the left-hand side of the equal sign by E1. You divide the numerator on the right-hand side of the equal sign by E1. And so you get a leading PE ratio. And then what you can do with a little bit of mathematics and algebra is you can reduce that to 1 minus B, which is the retention ratio, divided by R minus G. Now, of course, you can do this with the trailing PE ratio, and we do the same thing. However, it's P0 divided by E0. So trailing means this way. Let me go back here. Leading means that way. Of course, you guys are seeing this differently, so who knows what direction I'm pointing at. But trailing is just using the current earnings per share. Leading is an expectations. And so you do the same thing, and with a little bit of algebra over there, you can get that equation on the far right side. So let's take a look at an example here. So we've got some inputs in the question stem, and by the way, it would be awesome if the Institute were to give you just a table with all of the inputs, and then you could refer to the table. I tend to give these kinds of questions on my exams in the body of a paragraph, so I force the students to use their reading skills to kind of extract information that's relevant. And by the way, I always throw 1 or 2 pieces of irrelevant information into my paragraph, so don't be upset if you're given something that you don't have to use. Just throw it out. Be proud and confident in your skills and throw out something that you don't need. Like, for example, if here in this case, required rate of return is 12%, well, maybe that came from the capital asset pricing model. So maybe another line would be, hey, the beta is 1.1. And you're thinking, okay, where do I use 1.1? I'm not doing the right way. Well, they used the beta of 1.1 to get that 12%. All right, so what are we asked to do here? Oh, just compute those two ratios. So here, this is just a matter of doing the math. So you get this trailing PE 4.33 and the leading PE of 4.16. So notice they're relatively close together, 4.3. And by the way, feel free to stop the recording just so you can catch up on the math. Note the actual PE ratio is 13.33, so that's way out of whack from the 4 or so that we just calculated, and so we'll probably want to make a conclusion that the stock is overvalued. Let me read this LOS to you. Calculate the value of a non-callable fixed rate perpetual preferred stock. That sounds like this is the most complex question that anybody could ever ask. But the reality of life is this is the super most easy question. It would be awesome if the Institute asked you 100 of these questions, because look, all you have to do is take the current dividend and divide by the required rate of return. Now this is going to be the required rate of return on preferred stock. Notice down on the bottom left, the reading calls it the cost of preferred equity. So this is really just the present value of a perpetuity. Notice under the assumptions, growth rate is 0, so that's probably important. And so here's just a super quick example. All we have to do is take the, well, what are we given? I think this is the way the reading does it. A fixed rate of 10% on a par value of 100. So 10% of 100 gives you a dividend of $10, and then divide that by 12%. Make sure you divide by the decimal form of the 12%. So that gives you around $83. Strengths and limitations of Gordon. So what do we like about it? Yep, simple and easy to implement. Mature dividend paying companies. We said that before. We can determine whether the equity on those mature dividend paying companies is overvalued or undervalued. We can also use them as the last stage growth, which we haven't done yet, but we will. But firms really like to use this for valuing their shares when they're interested in repurchasing their stock. What do we call that? Treasury stock. And then G can be estimated using, well, it can be estimated using microdata, but it can also be estimated using macro data. What don't we like about it? It's very sensitive to the assumption that R is greater than G. And even if R is greater than G by just a little bit, like 10% and 9%, it's still not going to be very accurate. So, you think about life. Dividends, they tend to grow by, with these mature dividend paying companies, they tend to grow by, 2% or 3% or 5%. I mean, sometimes 6%, maybe for a large financial institution. And the required returns, if you use the capital asset pricing model, those required returns should be 12% or 14% or something around there. Limitations: when you have a more complex model like 2-stage or 3-stage growth, it has to be used in collaboration. Doesn't apply to companies that are non-dividend paying. And then the bottom right one, this is the one that I was talking about earlier. It sounds like a big limitation, and it probably is, but it's probably not as big as everybody thinks it is, just because the growth rate in dividends for these mature companies is pretty relatively stable. All right, how about multi-period models? So let's start with a 2-stage dividend discount model. The first stage represents a period of abnormal growth. The second stage represents a period of sustainable growth. There's a word that I used. Earlier. All right, so I want you to think about this. Let's suppose I'm Jim, and you guys know that I've used this example before. I'm Jim's baking company. And, I bake some donuts and I bake some cookies, and all of a sudden I have this great idea for some new fantastic cookie or cracker or donut, whatever it is. And it has all these ingredients that I'm convinced when people bite into this thing, they're going to just flood my store. So I'm going to have super high growth, right? Well, once my competitors start seeing, hey, look at Jim, he's over there. He just bought a new John Deere tractor for his backyard. Look at Jim, he just bought a new $100,000 vehicle. I wonder where he's getting the money. Oh, it must be because of this donut. So my competitors are going to start mimicking and making product lines that are similar, if not identical, to my donut. And so what happens then is that this high growth period is not sustainable. And so what happens is that this first stage is probably going to be relatively short term, maybe 4 years, maybe 6 years, where you have high growth. And I want you to look down on the bottom right there. It says where G sub S is the supernormal growth rate. So that's the term that textbooks typically use. Now remember, in my classes, my students are usually 20 years old. So in order to get their attention, and I'm going to use this with you guys today, is that I refer to this not as the supernormal growth rate. I refer to it as the super duper normal growth rate, because when my daughter was younger, we watched 1,000 episodes of Barney together, and super duper was one of her favorite words. So, it kind of resonates with them. Okay, Jim knows about Barney, and I'm going to remember that this supernormal growth rate has a relatively short time period because, are you ready for this? How long did you love Barney when you watched it? You didn't watch Barney for the rest of your life. You had a fixed time period where you watched Barney. Now for my daughter, that time period was way longer than what I wanted, but I was happy when I was done watching Barney. All right, there's a good old formula down there on the bottom left, and really what we're just doing is separating into its two components. So what's the value of a stock? It's the present value of the vague promise, right? The high growth dividends, and then the present value of the normal growth dividends. Now, this typical two-stage model goes something like this. Back in my donut example, let's suppose that I think that I can grow by 50% for 5 years. So 50%, right, for 5 years, and then it's going to fall down to its normal growth rate of, let's say, 5%. So there's the illustration on the left. This is the basic two-stage model where we have 50% and then we drop. We have a sudden drop. And that's not too terribly realistic because firms typically don't have changes in almost any of their variables, let alone growth rates in dividends by that substantial a drop. And that's what the H model does. The H model assumes a linear decline over that growth period. So instead of Jim's baking company growing by 50% for 5 years, maybe it grows by 50% in year 1, then 40% in year 2, then 30%, then 20%, then 10, then down to 5. So there's that linear decline. And so this one is, what does it say there on that third circle point? Transition from super duper growth. Notice we didn't put that super duper growth. I'm editorializing on that here. To mature growth, it's relatively smooth, right? So there's not that big jump, the big jump downwards or the big drop. So there's the equation for the H model. And all we're doing here is taking the present value of the, look at the top left of the top left of the numerator. That's the present value, just like the regular old Gordon growth model. And then to the right-hand side of the plus sign, that's the present value of the linearly declining dividends. Now, what we've done for you on this slide is the following. Look at the last part of that LOS. So explain the assumptions, justify. We're doing that a little bit here. We're going to calculate these in just a few minutes. But the last part of that is or spreadsheet modeling. So I thought what I would do is go to my best friend Excel and just show you what this might look like in the spreadsheet modeling, even though, of course, you don't have Excel during the exam, but this goes a long way in explaining these assumptions. All right, so let's read my 3 circle points up there. Lots of positive NPV, accelerated growth for a period of 4 years. Competition increases dramatically so that the growth falls to a more normal rate of 5% afterwards. Okay? The board declares a year one dividend of $2 and it expects it to double. All right, so here's a 100% growth rate. So I purposely picked an extreme growth rate to illustrate a point here in just a second. Shareholders require 14% return. Just assume I got that from the capital asset pricing model. So notice what I've done down the left-hand column. Year 1, 2, 3, 4, and 5 dividends. So there's the $2 dividend. So it's going to double. It's going to double to 4. It's going to double to 8. It's going to double to 16. All right. So that's 100% of super duper growth rate. But then in year 5, it's going to fall to a more normal 5% growth rate. So the dividends, let me say this again, 2, then 4, then 8, then 16, and then only to 1680. Okay, so you see that the doubling of that dividend over that 4-year period really dramatically increases the dividend. Of course it does. And then on the next column, I just take present value and you sum that and you get a price of $130. Those of you who are interested in Excel formulas, I went ahead and hit my Control tilde button and I showed you those formulas over there. So here's the price using this 2-stage dividend growth model in a spreadsheet modeling. I mean, really, look, it's just the present value of the high growth dividends plus the present value of the normal growth dividends. And by the way, look over on the second box under the PV column and go down 1, 2, 3, 4 to the 5th box. Notice that I have B6, which is the 1680 divided by 14 minus 5, and those are in decimal forms. There's the Gordon growth model that we're using inside of this more complex 2-stage dividend growth model. So this 2-stage dividend model, we use that Gordon growth model in there. Now, okay, let's go back up to that LOS. Explain the assumptions, justify selection. Okay, so I'm addressing the justify selection part of this LOS. All right, so here, why do we like this? Why do we like this model? Well, because it's going to give us a fairly accurate price when a company experiences super high normal growth, right? 100%. So here, you can't argue with the math, right? Here's the math. The math is what it is. But then one might say something like, well, Jim, really, you're not going to be able to grow by 100%, 100%, 100%, then just drop down to 5%. You're probably going to get competitive forces against you early on. So maybe you'll grow by 100% and then 75% and then 50% and then 25% and then 5%. And then you think, oh, that's awesome. Let's use the H model. Well, look down on the bottom, the H model, you do all the math there, you get a price of $32. Oh my goodness gracious. So justify the selection. So in the reading, it tells you this specifically. When there is a huge difference between the normal growth rate, like 5% in this example, and the super duper growth rate, like 100% in this example, the H model fails terribly, and I show you the math right there. So you're going to justify the selection of the H model only when the super duper growth rate is, let's say, 16% and the normal growth rate is 8% and the time period is 6 years. So you drop that growth rate linearly by, what would that be, like a 1.5%. When those two numbers are relatively close together, then the H model is a terrific shortcut to use. But you can always use this spreadsheet analysis. Now, we're going to do a little bit more calculations in a few slide decks, but I wanted to show you this to illustrate spreadsheet modeling and then when not to use the H model. Now, as your brains have become scrambled eggs going from Gordon growth to the 2-stage to the H model, let me scramble them further by extending this to the 3-stage dividend discount model. And really, it's no more complex than the 2-stage. Look at the boxes over there. We have 35%, 20%, and then 10%. And so you just compute those future dividends and calculate their present value. It's really super easy. But what we do for you here is go ahead and show you this in an illustration. So here we go. Estimate yearly dividends over the first 2 stages of growth. Discount those. Estimate the dividend for the first year of the 3rd stage. And look at the 4th circle point down there. Calculate the terminal value at the beginning of the 3rd stage. Make sure you understand this. When you calculate the terminal value, that's when you are using the Myron-Gordon growth model. Let me prove it to you back here. Where am I? Looking at under P all the way down into that, what is that? The 5th block. There's the B6, which is that 1680 divided by 14 minus 5. So you're going to do that in the 3-stage model, just like we did it here in the 2-stage model. And this is known as the terminal value. Think of it this way. That's really your future selling price of the share of stock. You're taking the present value from time period 3 all the way out to infinity. So you're just thinking to yourself, okay, this is what I'm going to sell my share of stock for after I receive that last super high dividend. Now, there's another way to do this, and this is similar to the 1st stage of the H model. So calculate yearly dividends and their present values. But now apply the H model to the period between 2 and 3, because you think about it, you have this first period where you have lots and lots of growth. Then the 2nd period is declining growth, and the 3rd period is normal growth. So the math of this is probably, should be relatively straightforward. And then, of course, you can do spreadsheet modeling here, which is going to be virtually identical to what I showed you just a few moments ago. Now, let me go ahead and go back to this. What I love about my favorite Excel spreadsheet is that, you can write a macro in here and you can change one variable and then everything else comes out and you don't have to do all of the work. Oh, I love having my students do that. Sensitivity analysis. They get so sick of that from hearing from me. Look at the bottom circle point here. This is important in terms of assumptions and justify. Reduce the probability of computational inaccuracies. I like that. All right, explain growth, transition, and maturity phases here. All right, so of course, depending on where the firm is in its business life cycle is going to determine what kind of a model that we use. All right, so if we're in the growth phase, what does a growth phase mean? Rapidly expanding, high profit margins, probably negative free cash flows, probably 0 dividend payouts, or maybe low dividend payouts. They probably have a supernormal growth rate, right? Everyone's eating Jim's Donuts. And then there's a transition phase where we slow and we probably don't need to reinvest because we've done all of that in investment in technology and retooling our equipment and all that stuff. And then, of course, free cash flows, in particular, free cash flows to equity turns positive. And then we start increasing our dividends, and then the payout ratios increase. In the mature phase, then we probably want to say something like, boy, the return on equity approaches. There's an equal sign there. That's what the reading does. I'm going to say, how about it approaches the required return on equity? Earnings growth and dividend payouts stabilize. That's what I was telling you earlier about, these mature companies. Gordon growth model can be used. Yeah. So we've covered a lot of this stuff in these three blocks, but those are good summaries of what we talked about earlier. All right, terminal value. I've also described this before. Use the Gordon growth model. Calculate it at the point in time when forecasted free cash flows start to grow at a constant, stable rate. You can also apply some multiples, as we'll do in just a little bit. But I want you to think about this. Think about this terminal value as the expected future selling price, which is like your capital gain. All right, let's take a quick example here. So we have earnings of 326, 365, and 420. We have a trailing PE multiple of 30. The value of the company is closest to. Well, terminal value at the end of 2019, let's go ahead and take that 365, that earnings per share, and multiply that by the trailing industry PE. So there we go, $109.50. Remember those earlier LOSs sounded something like, explain and discuss and justify these models. And so what we're going to do now is we're going to calculate and interpret and explain and justify all of those. So let's go ahead and work through some calculations. There's the big old formula right at the top of the page. My advice for you is to take that and punt it out of the end zone and just do the math like we do on the next slide. So here we go. Current dividend of 50 cents. We have growth rate of 3 years of 8%, and long-term growth of 5%. So here, look at this. From my example on my spreadsheet, I had 100% super growth down to 5%. Here it's just 8% down to 5%. So this is much more realistic than my crazy example earlier. Required return 13%. Be prepared to use the capital asset pricing model. Oh man, dare I even say be prepared to use the arbitrage pricing model or some kind of a 3-factor model to come up with that 13%? I would ask that question like that. I'm not sure if the Institute would. So determine share price. All right, so a couple of steps here. Let's go ahead and calculate the first 3 dividends. So what were we given? We were given that current dividend of 50 cents, right? So 50 times 1.08. That gives us 54, so then D2 is 58, and then D3 is 63. So we've got D1, D2, and D3. Those are the supernormal dividends. But then we need to compute the year 4 dividend, and that's only going to grow at this 5%. So you take the 63 times 1.05, and that gets us up to 66 cents, okay? So step 3, look at what we're doing here. Look at this, V3. So the value at time period 3 is going to be 662, which is D4. That should make perfect sense. So D4 divided by 13 minus 5, that gets us the 8.275. So put that in your notes right here. Put this in your brain. That 8.275, that is the terminal value, right? But it's also the expected future selling price. So this is how I want you to think about this. This is what I said earlier, but I think it is worth repeating. So what are you going to do if you buy this share of stock today? You're going to get 54 cents, you're going to get 58 cents, you're going to get 63 cents. Immediately after you get that 63 cents, you're going to run to the New York Stock Exchange and sell your shares for $8.27.5. So what is the value, V sub 0? The value of this firm, are you ready for this? It's the present value of the dividends, right? 54, 58, and 63, and the present value of the future selling price, which is the capital gain. What did I say in that first slide? I might pay you a dividend and you might be able to get a capital gain. Well, here's a really super cool model that's giving us the answer. So we're going to spend $7.10 on that share of stock today. We're going to get a bunch of dividends, and then we're going to sell it for $8.27. Oh my gosh. So there we go. Present value is terminal value. That's the future stock price. But here, this is probably an important part of the LOS. Look at that second arrow point. The present value of the terminal value makes up 81% of the total value. Which means the valuation is more sensitive to the growth rate and the required return assumptions of the Gordon growth model. Now let's go ahead and do the H model here. So current dividend of 80 cents, 8%, 5%, and 5 years required return, current share price. So determine the value. Determine the intrinsic value. If you do all that, you get $12. And the interpretation is that the value of the stock would be $10.50, but we're getting some extraordinary growth that adds $1.50 to its value. Here, let me go back here. So that gives you the $12. Now remember, in this H model, we are assuming that the growth rate, what is that growth rate? 8%. It linearly falls during that super normal growth period, which in this case is 10 years. That's because H is 5. Oh boy, here you go. Did you have scrambled eggs earlier? Here's some more scrambled eggs. So calculate the value based on the 3-stage dividend discount model. So we have current dividend of 2%. So we have growth of 14, growth of 12, and then a perpetual constant growth of 6% determine the value of the stock. So we're going to just do the same thing that we did with the two-stage model, but notice we have D1 1.14, D2 1.14, so we're compounding it at that higher growth rate, and then D3, 4, and 5, there's the 1.12, we're compounding it at the lower higher growth rate, right? And so we calculate the year 6 dividend at 6%, and then we just do the same thing that we did before. So you get $56.52 for this three-stage model. So let's take a deep breath before we move on to the latter part of this slide deck. I know we've been going for a long time, but bear with me. Come on, guys, stay with me. Let's just take a deep breath. All we've done is we've computed the price of a share of stock based on the present value of the dividends and the present value of a future selling price, and put in parentheses terminal value. Now, how about if we want to use the Gordon growth model to estimate the required return? All we're doing is rearranging the model, and there it is. So required return is equal to D1. So it's still D1 in the numerator divided by P0 plus the growth rate. And there you have a quick example at the bottom. So be aware that you can rearrange Myron Gordon's model to solve for, what did we do earlier? We solved for the growth rate. In one of those previous slides, now we're solving for the required return. Now let me just remind you, we use that rearranged version to calculate something called the implied growth rate. And this is just called, we're solving for the required return. Now we can also do this by using the H model. And we're going to use our regular old H model formula, do some good old algebra, and we get that equation there. And so it's up to you guys to decide whether or not you want to memorize that. And, you know, I did. But then again, I teach this stuff, so it wasn't too terribly difficult for me. So there you go. You get about 13.5%. How about general spreadsheet modeling enables analysts to create pro forma income statements and balance sheets? Okay, that makes sense. Perform scenario analysis using various estimates. I mean, that makes sense. But here's where this LOS comes in. Once you put together those pro forma things up there that we did back in our financial reporting, then you can use those accounts as inputs for the different stages, for the growth rates, for the required rates of return. So here's just a super quick example, scenario 1, 2, and 3, where we have different kinds of growth rates, right? We go from 25 all the way down to 6. We have 25 all the way down to 14. We have 25 all the way down to 14. But then 5 and after, we have some kinds of different assumptions. So this is just one quick example of what you could put into an Excel spreadsheet. So what did we do earlier? We did the implied growth rate. Let's go ahead and compute the sustainable growth rate. Implied simply means that we extracted it out of the Gordon growth model. The sustainable growth rate is we're going to compute it based on pretty relevant things. So let's go back and talk about our present value of growth opportunities here for just a second. What was that example I gave you? The company generated $10 in earnings and paid out $2 in dividends. Therefore, it had $8 or 80% to reinvest. So that's the B, the 80%. And then if you multiply that by profitability that is specific to the equity portion of the balance sheet, return on equity. So if you take the retention ratio times profitability, return on equity, you get this sustainable growth rate. Now, I use this in my classes all the time, and so my students are perfectly aware of this. One of the things that I don't really emphasize too much, but the Institute does, look at those two circle points that are indented. This is only good assuming that no new equity is issued, because that's going to change return on equity, it's going to change other ratios, and that capital structure remains unchanged. So look at that circle point there. The sustainable growth rate shows how quickly a firm can grow with internally generated funds. So what are those internally generated funds? Think Milton Hershey, think of chocolate bars, right? And Hershey Kisses and all those things. What are those operating cash flows that Milton Hershey generates every day? Just suppose it's 100, right? So how can Milton Hershey grow just by reinvesting those $100 back into Hershey's chocolate and all that other kind of stuff? Internally generated funds. How about this DuPont model, which we talked about back in financial reporting? And so what we're doing is we're going to divide return on equity, and just let me remind you here, there's return on equity in the blue circle, so this is an important measure of profitability. What we want to do is divide it into its component parts, and that's what I've done. That's what we've done in the green color. So we've got net income over sales. We have sales over total assets. We have total assets over shareholders' equity. So what do those things represent? In the green, we have some measure of profitability, right? In the red, we have some measure of performance. And in the purple, we have some measure of leverage. So what do we want? I mean, of course, we want lots of net income out of our sales. You know, that goes back to what's the goal of the business? Maximize shareholder wealth. How do we do that? We generate lots and lots of operating cash flows. Well, how do we do that? Well, we have lots of revenues and minimum expenses. So that's what that profitability tells us in the green. And then in the red, some measure of performance. What do we want to do? I mean, we want to buy an asset. If I'm Jim's Baking Company, I want to buy a machine for $1,000 that makes donuts, and I want to have $1 billion in sales, right? 1,000 in assets generate $1 billion. All right, so we want that number to be high. And then in purple over there, boy, this is the marginal cost, marginal benefit. Do we want to issue the bonds, which is the explicit promise, and then we have the specter of default if we issue a bond. So that purple tells us about how leveraged we are. And let me just comment here that, of course, that purple ratio over there should reflect the firm's desire to reach its target or optimal capital structure. And so then look at the bottom. What we can do is we can estimate the growth rate using all this DuPont stuff. And so, oh, there's the growth. So there's what I was telling you about just a few moments ago. Let's go ahead and look at an example. So profit margin, here's all that stuff. You can pause the recording and go ahead and do the math here. And so what does that give us? That gives us a growth rate of 4.56%. So here we go. I want to address that. So the calculation, that should be okay. But the interpret, this is what's important. So when we get that 5.46%, what are we saying? The sustainable growth rate is a function of things like, okay, how much did we pay in dividends versus how much did we retain? How profitable are we? Well, how do our assets perform in relation to our sales? And then how much debt is in our capital structure? So that sounds an awful lot like, here, let me do this. Can you guys see me? Let me wrap my arms around the financial statements and let me squeeze those financial statements, and out pops this growth rate of 5.46%. So now we can use that with confidence back into any of those other models that we used earlier, with confidence that it is sustainable and it's not just picked out of the air. Remember Jerry Seinfeld says, anybody can take the reservation, but you don't know how to hold the reservation. So that's what we're doing here. We're not just trying to say, okay, we think we can grow at 5%, but now based on our skill set as executives and the profitability of our product lines, we believe fully, and we can hang our hats on that 5.46%. How about fairly over or undervalued? All right, so we use all these models here and we come up with a price. And let's suppose that price is $100. And then we log onto our phone and we look at the stock price and it's $100. Well, there we go. So that's fairly valued. And of course, in one direction, it's overvalued, and in the other direction, it's undervalued. And so that takes us through, oh boy, I don't even want to count how many of those LOSs are. And I tell you what, this is a super important reading. There are lots and lots of great exam questions for all of this. So I'm going to tell you guys to focus on all of these LOSs.